The cost of buying a property is way more than just the deposit, so let's talk about it. Hi guys, welcome back to my channel. My name is Jadesola and I am right in the middle of buying my very first investment property, and I thought to share with you how much money you need to save before buying an investment property. Now, if you're thinking about buying a residential property for yourself, which is the one that you're going to be living in, there's still some things that I'm going to be sharing in this video about how you should approach saving for a residential property. Anyway, let's get right into today's video. Now, you find out a lot of the times when people are talking about buying properties, they only always emphasize on deposits, the down payment. But there's so much more that you're going to be spending money on even before you collect the keys of the property, and a lot of people don't talk about it, and it's very important because these monies, sometimes they may look small, but they continue to add up. So what I'm trying to say in essence is that apart from your down payment, there are also closing costs that you will need to save up for before you can buy an investment property. Now, if you're trying to buy an investment property, you need to think about the things that the lender looks for. Now, I'm assuming that you're like me, you're trying to get a mortgage, because if you're a cash buyer, you don't need to worry about some of the things. You have money, you're bougie, right? This video is probably not for you because you have a lot of money. Anyways, if you are trying to buy using a mortgage, here in the UK, the lender would look at a couple of things before they can say yes to you. Now, they want to know if you have an annual income of a minimum of £25,000. So if you're a salary earner, you can show that. If you're self-employed, you would have to speak to your broker on how you can show that you have an annual income of £25,000. I'm not entirely sure how they would appraise you if you are self-employed, right? I'm a salary earner and I earn more than £25,000. Now, the next thing they're going to look out for is if you have 20 to 25% deposit. Now, I say 20 to 25. There's some lenders that would finance up to 80% of the value of the property that you are looking to buy, whereas some would only do a maximum of 75% and you have to come up with 25%. I would just say, based on what I did, I based my own on 25% deposit. And I think it's safer for you to save more and realize that you don't need it than to save less and assume that a lender is going to finance up to 80% of that property. Another thing that the lender would also look out for is the rental yield on the property. The lender would always want your monthly rent that you're going to be generating from that property to be at least 1.25 times the monthly repayment on your mortgage. For example, the potential rental income you can generate on a property you're trying to buy is £1,000 a month, and your monthly repayment to your lender is £500 a month. If they check it, they would see that you are earning twice the amount, which is actually way more than the 1.25 times that is required in order for them to approve up to the amount that you are asking for, which in my case is 75% because I'm trying to put down 25%. So that's another thing that the lender is going to look out for. The third thing they're going to look out for is the value of the property. If, for example, you have told the seller of the property that you're going to pay £100,000 to buy this property, and then the lender goes to do a valuation on the property and they say, hey, this property is actually not worth £100,000, it's actually worth only £80,000. It means that whatever thing they're trying to lend to you is going to be based on £80,000 and not on £100,000. And this is where things start to get complicated. What this means is that the down payment that you initially, thought you were going to need is now not what you're going to need if you want to continue to go with that property. You're thinking to yourself, I'm only going to need £25,000 for this property, and the lender has now said that the property is not even worth £100,000. It's only worth £80,000, and they would only finance 75% of £80,000. If you want to go with that property, then that means that you are the one that is going to come up with the difference to make up the amount that you're going to need to pay to the seller. And this is where the costs starts to go up. So now let's talk about how much you actually need to save in order to buy an investment property. So the first thing is you need to have a budget, right? Because that is going to determine the kind of properties that you're going to be viewing. If, for example, your budget is, say, £100,000, there's actually no need for you to be looking at properties of £500,000, right? You would be looking at something in the range that you're looking at. You can look at maybe properties slightly above or below, but you know that, hey, you have a budget of £100,000 to buy a property and then you're looking to save 25% of that as your down payment. Now, there are closing costs, like I said earlier, that you need to factor in. One of the costs that you may not even plan for is what they call product fee. This is the fee that the lender may charge you. It could be a percentage of the value of the property or the amount they're giving you, but these are monies that you may not plan for. And sometimes with this product fee, some lenders may require you to pay it upfront, and some may be generous enough to just add that as part of the loan that they're going to give to you, and then you will pay that in the life of the loan, so you don't have to bring that out of pocket. But it's safe to just have maybe between £1,000 and £1,500 as product fee, just in case your lender says you have to pay the money upfront. Another thing that you may have to pay for as part of your closing costs may be valuation fee. Now, this is the fee that the lender is going to use to travel down to your property that you want to buy and get someone to value the property and check that everything is okay for them to use the property as security for your mortgage. Now, there are some lenders that will do this for free. Some would charge you, and this is money that you have to pay upfront. Another closing cost that you cannot escape is legal fees. After your mortgage is approved, you always need a lawyer to help you to close the sale. So you're going to have to pay the legal fees. You're going to have to pay for searches. If you are buying an investment property in your personal name, they will do a search on you. If you're buying in your company name, like I am trying to do, you would also have to budget for extra search fee that they would use to do a search on the company as well. Another cost that you're going to incur in the UK here, if you're trying to buy an investment property, whether it's your first investment property or your 10th investment property, is stamp duty. And it's usually 3% of the price of the property. So you can already see that, hey, just thinking about 25% as deposit is now not going to cut it, because all these fees are now starting to add up. I would also advise that as part of just even being safe is that you have like a down payment buffer, which, you know, it could be just miscellaneous monies that you did not think that somebody is going to ask you to pay in order to be able to close the deal. So like I said earlier, the lender looks out for the value of the property and the value that you can generate as rent on the property. If, for example, you think that, hey, you can generate £1,000 on the property on a monthly basis, and the lender says, no, in this area, it's £800, they're going to factor that in when they want to determine how much they can loan to you. It means that if for any reason, the 75% financing that you're looking for from your lender comes down to 73%, you need to have the extra 2% to pay the seller in order to be able to buy the property. So I would always say budget another maybe 3 to 5% if you can, and just save up that. These are monies that if you don't use it, it's not a problem. It's still your money. But just in case you need to use it, you have to start thinking about it. Just because you think you need, you know, X percentage doesn't mean that you should have that exact value. Another thing that you need to start to plan for is post-closing costs. So renovating the property, furnishing it, making sure that you set up the property to a point where it can now start to generate you income. These are monies that you really need to consider having. You cannot say you're buying an investment property that you want to rent to people and not be able to put it in a state that you can list it online and get people to come and rent it. If you want to do serviced accommodation or HMO here in the UK, you need to furnish the property as well. So you need to think about saving up the money that you're going to need to furnish the place, because if you can't do this, then you cannot start to generate money on the property. Another thing that you have to think about is the initial running cost before the property starts to generate money for you. So there may be a period whereby you are actually paying the mortgage repayment out of pocket before you start to earn from the property. And just knowing fully well that your lender is going to be expecting the first repayment from like the first month after they give you the money. And you can't go to your lender in the first month and be saying, hey, you don't have the money to pay for the mortgage repayment because you're still renovating or you're still yet to furnish or something. So you need to think about, having a bit of money, even if it's just the first 2 months of the repayment, that you have that saved up as well, so that you have a bit of peace of mind and just know that, hey, you have this money saved up and you don't have to worry about, hey, somebody coming to say, hey, how come you're defaulting in your first month. So this is how I planned my savings when I was actually saving. I saved a bit more than 25%, and I've had to incur all of the costs that I've talked about in this video. I've incurred a product fee, I've incurred valuation cost, I've also incurred the cost of the extra down payment, because the rental yield that I thought that I was going to get on the property is not what the lender thinks I can get on it. So in my opinion, I'll just say try to save all between 5 to 15% more than you need as down payment when you're trying to buy an investment property. And I've made the gap really wide because, again, there's stamp duty for people in the UK, which is 3% of the cost. That's already 28%. So if you're saying, okay, let me just save additional 5%, you may not just cut it. And there's renovation costs, there's furnishing costs. So that's how I've saved, and that's how I'll probably encourage you to save as well. Anyways, I've come to the end of another video. If you have enjoyed this video, you know what to do. Please make sure you like, subscribe, and share. And I will see you next time. Bye.